Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's actually done his own show and podcast, the McAlvany Weekly Commentary, for over 15 years. He's a second-generation money manager. He's the CEO of the McAlvany Financial Group, including a bullion dealer that has been run by his father initially since the 1970s. He also has the vaulted.com app, which offers the ability for retail investors to buy physical gold and silver at very, very low premiums. David McAlvany, thank you for joining me again.
Hey, great to be back with you, Jason.
So, David, we're recording this interview on Tuesday, April 23rd, 2024. Let me just go through some of the key points here about the markets right now. The 10-year US Treasury yield has rallied a lot in yield spiked up to 4.6% from 4.2% only about a month ago. The dollar index has also rallied up to 105.7, although it's down a little bit in the last week. And the gold prices have corrected a little bit, but we're up $250 an ounce, give or take, to 23.10. Silver is also down a little bit. I want to get your thoughts on the global macro situation first. Where are we right now, in your opinion, with like the U.S. economy, what central banks are doing, the global economy versus asset prices?
Starting with the U.S. economy, it's strong, but if you said, looking at GDP growth and the quality of growth, I think that's what is suspect, because you're dealing with a tremendous amount of government spending, specifically deficit spending, to get us to sort of the robust level that we have currently. So, if you're spending an extra $1.5 trillion, $2 trillion that you don't have, it's still money that's being spent. And, so it is truly a form of economic activity. So, you get credit for that in the statistics. But I think what that overstates is the real strength of the consumer. And, with 70% of our economy traditionally coming from the consumer, it really does matter how strong the U.S. consumer is. And I think there are some intriguing data points, on both sides. If you look at retail sales, it's pretty strong. If you look at a number of credit card companies, Discover comes to mind. They've got their delinquency rates now at levels that are higher than they were in the worst of the global financial crisis, third and fourth quarter of 2008. We're already past those levels for Discover Financial. And so, I think you can look and say it's not real clear if the U.S. economy can continue at the same pace it is. In other words, you can't just consider it to be a strong economy and immune to pressures. In fact, some of those pressures, some of the cracks may be emerging amongst consumers, number one. And, most recently, last week's NFIB survey of small businesses showed our lowest levels since 2012. So your small business owner is saying it's not great. Yes, we're concerned with inflation, and couple that with the consumer continuing to be under pressure. It's kind of point and counterpoint in terms of the strength of the economy. I'd say we've gone a long way and have maintained the levels we have with funny money.
So you're saying then that the budget deficits and the Fed hasn't really drained the liquidity like they've claimed. So yeah, the Fed's official balance sheet is down, but they added the BTFP and these other liquidity programs. So it's kind of like a shell game where on one hand, people are looking at, the Fed's official balance sheet is down by over $1 trillion. But on the other hand, the banks are tapping these liquidity programs still like crazy, and that's juicing asset prices.
Exactly. The budget deficit at these levels is on par with what we've seen during major world wars. So, are we in a major world war? No. Are we spending like we are? Yes. So what gap are they trying to fill? That's a good question. The budget deficit is a big deal, and the sustainability of our fiscal picture is coming more into focus for investors, which I think is one of the reasons why, gold has gained and is gaining more attention in the investor community. And it's this notion that a couple trillion this year, a couple trillion next year. Now with the interest component on the national debt getting to levels that, rival any other budget line item. In fact, last year's exceeded the defense budget at over $1 trillion, basically $1 trillion in interest payments. People are realizing the budget deficit matters, the total quantity of debt matters, and if interest rates don't come down the interest component is enough to really do damage to our reputation.
So you don't think we can have a continued environment where the dollar keeps getting stronger, interest rates like the 10-year US Treasury stay relatively high, and gold keeps going higher? You think then that combination of those things spells, asset price correction and other problems in the real economy?
Well, there's a couple things. I mean, if you look at the dollar being strong or getting stronger, that creates a tremendous amount of pressure for other markets. If you're looking at carry trade dynamics, you've got pressure which emerges there. If you're looking at emerging market debts, emerging market currencies, pressure that would really damage the global economy. So a stronger dollar might be good for us, but it's kind of not good for anyone else. And, very curious that with the higher rate environment and a relatively strong dollar, gold's put in all-time highs. Again, I think that goes to the question of who's buying and why. If last year it was the Chinese and central banks, sort of propping up the gold market and pushing it ahead, this year I think we will see a transition, particularly in the second half, U.S. investors finally paying attention to the gold market, not on the basis of dollar strength or weakness, but on the basis of, that big question, fiscal viability.
And I think the last time we had kind of this scenario where interest rates were raised this much or relatively high in the US, a strengthened dollar because Paul Volcker was fighting inflation and trying to strengthen the dollar, and interest rates on a relative basis were high, and a gold rally like this was the 1970s stagflation.
Yeah, I think one of the things that is forgotten, we look at the Fed funds rate, and yes, it came off of a very low level. It wasn't that many years ago that we had the 10-year Treasury marked at 32 basis points. And, today, you mentioned it earlier, 4.6%. And, that is a big move for the 10-year, Fed funds even higher. But looking at the Taylor rule, we should be over 6%, over 6.25%. So on that basis, you could argue that we still have an incredibly accommodative monetary policy, and financial conditions remain very loose.
So you don't think then that what the 10-year, if it goes to 5%, I've been seeing some experts predicting that there's a bond bear market, long-term bond bear market, not just the last 3 years, but it's going to go for a very, very long time. That if the 10-year goes to 5%, that it's not going to create even worse headwinds for entities that are not a large corporation with a lot of assets, or a government, all the other entities, the consumer, small business. You don't think they're going to get hammered from a huge spike in the 10-year US Treasury yield continuing?
I think this is where, the conversation on yield curve control and monetization of debt here in the United States, moves center stage, because, corporations still have another 2-3 years before they hit maturity walls and have a lot of debt that's rolling over, enough that would be consequential for their survival. If you're talking about, marginal borrowers in the corporate landscape, certainly they're being impacted even now. But if you're talking about, your really good credits and then I think you're really talking about 2 to 3 years before there's much of an impact from higher rates. Where the real impact is in government bonds. And, that's where I think it was Michael Hartnett who suggested that, from Bank of America, that if we don't see 1.5% decline in the Fed funds rate by the end of the year, we'll be looking at interest payments of $1.6 trillion. So that's pretty significant. That's not the same kind of effect that you'd see in the corporate bond market, because, again, the maturity wall is farther out. We're hitting the wall here in the U.S. right now. 14 trillion to roll over between this year and next year in government debt. And so we're coming off of 1.5-2% rates, and it's getting marked up to 5. Most of that's not being financed longer term. We had an abysmal bond offering last week, the 10-year, only 38% of it was taken by the market. And your primary dealers basically got stuck with the rest. So they're being forced to finance things at the short end of the curve, at rates that are, again, 5, 5.3, 5.4. I mean, that's stuff that impacts our budget considerably. because the interest component, again, we were $1 trillion last year and $1.6 trillion this year. Hartnett's right. I don't know how you reduce rates by 150 basis points unless it's in response to, a stock market meltdown.
Yeah, I don't know what type of excuse they can give because what the front end of the curve is saying that the Fed can't lower interest rates. Also, the CPI readings have come in a little bit hotter than the Fed wanted, so they're giving that as an excuse why they can't cut. I mean, the Fed dot plots were predicting what, 8 rate cuts or something, 6 to 8 rate cuts at one point early in this year. Now we're down to maybe 1 or 2.
Yeah, and it was funny listening to Powell at his most recent meeting. This goes back a few weeks. His kind of hemming and hawing about we will be data dependent, but the fact that we've had January and February CPI numbers come out hot, it's not enough data to make a decision. Then March comes out, to your point, 3 in a row of higher than expected CPI prints, and now the question is, if they're data dependent, they should be considering an increase in rates. And, so they set themselves up for a bit of a credibility check or credibility crisis. If they don't do what they said they were going to do, they just communicate to the market the data doesn't matter. They've got other agendas.
Do you think that the Fed is trapped based on the spending that DC is doing, both political parties, the White House, Congress, and then now interest payments on the debt, which are at least $1 trillion, and then the Bank of America analyst, I think he says 1.6 trillion by December of this year. So he's estimating that it could get up to 1.6 trillion in interest payments by December of this year.
That's right. Absolutely, they're trapped. They need rates to go lower, and yet they haven't put the inflation genie back in the bottle. So what do you do? That's being on the horns of a dilemma.
Well, I mean, at this point, no one in Congress that's in a major political position, power position, actually wants to cut spending. I mean, there's people here in DC that are talking about spending even more.
Classic during an election year, and we've got more elections globally this year than is typical. So it's not just our fiscal picture, which is strained, but it's other governments around the world who, incumbents don't mind spending and don't mind, tapping the pork barrel to make sure that their constituents are happy coming into whatever the election time cycle is.
Yeah, I have the budget deficits. The fiscal 2025 budget projections that the Biden White House released in the last 6 weeks, I think, are absolutely ridiculous with the assumptions. They're projecting only a 1.8 trillion budget deficit, but they're also magically assuming that $1 trillion of tax receipts comes in. They're claiming that another 10 trillion of debt won't be added, I think, for another decade. I mean, the assumptions in there are just absolutely ridiculous.
Well, on the revenue side, they will get an improvement from capital gains. Last year they definitely took a hit from significant decline in equities from 2022. So what we saw for 2023 revenue was down by about 10%. If you add that back and then are generous on the revenue assumptions, I think you get to 5.5 trillion. But again, you back of the napkin math, 1.6 in interest payments with 5.5 in revenue. You're coming up on 30%. That's a little scary. And I think that's what, again, we come back to what is the gold market telling us in an environment where typically you could expect gold to be $300 to $400 lower, given the strength of the dollar and higher rates. What the market's telling you is that there's people figuring out the Fed is trapped.
Well, also, I think it's a supply demand issue in treasuries, Dave, and you were highlighting this with the primary dealers getting stuff with more treasuries. The normal buyers of treasuries, whether that was China, Japan, Germany, our trade partners that ran the largest trade surpluses and then recycled foreign exchange reserves, they're just not net buying. I mean, it looks like Japan's probably going to be selling US treasuries to defend their own currency.
And this gets to your point about it there being a longer term bond bear market. If there's oversupply, you can resolve that with adequate compensation. You can improve the demand picture if you pay people more, but that implies that interest rates are going higher. And that is a bit of a problem for the government. It's great for the owner of that debt. It improves their financial position, but it's tough on government.
I want to ask you about fiscal dominance because I know you've been covering yield curve control, financial repression, Japanification. You've been going through these white papers from the IMF, reading the books for Carmen Reinhart and Ken Rogoff for over a decade now. Your interview with Carmen Reinhart from 2015 on the McAlvany Weekly Commentary was absolutely superb. I've listened to it, I think, 3 or 4 times because, she was basically just predicting with the math what was going to play out now years later. Is fiscal dominance any different than any of the stuff that you've been discussing, like yield curve control, financial repression, Japanification that you've been talking about for years, or the white papers that these PhD economists and policy advisors have been talking about?
No, it's just it is the environment in which your financial repression is the policy choice. We can expect that losses will be assigned, and that was Reinhardt's conclusion. Was basically we're in a position now where we're going to have to choose the winners and losers, and from a policy perspective, we have to corral investors. And once we've gathered them in, then we start assigning the losses. You choose who it's going to be. Is it going to be the commercial banks? Is it going to be the savers, the households? Who's it going to be? And so I do think fiscal dominance makes financial repression just it's a given. It's a given. To be able to direct credit flows is a part of that. To maintain higher levels of inflation than even the stated official statistics. That is a classic way of alleviating the pressure of debt. And that is what we see.
So for listeners out there, financial repression right now would be not just the US, would be all these governments potentially discussing either cutting interest rates or not raising interest rates that much more. They're going to let inflation run hot, and what they're going to try to inflate away the debt in real terms. So I think that's what we're starting to see now, not just with the US necessarily, but I just sent you that chart that the Wall Street Journal published, and it looks like a lot of these governments are in kind of rate cutting, yield curve control mode where they want inflation to run hot. They want the real inflation rate above the yields on their government bonds.
That's exactly right. I mean, we coming out of COVID are not alone. There's a lot of governments who were spending just to sort of save the world. And so now we're dealing with that sort of debt hangover, way too much debt, and no real way to gin up enough economic activity to compensate for it. So what do? This is almost textbook. Yep, run inflation hot and allow the households to bear the brunt of that. Most people don't understand financial repression, but if you should be compensated 5 and you're compensated 2% instead, the difference there accrues, the benefits accrue to someone else. You're paying the price for their bad policies. And I keep on coming back to gold. Gold is that signature. It is that signal within the markets that enough people are beginning to get it, and that if they don't want to be subject to that financial market corralling and loss assignment, then you have to opt out. And it's the best financial asset if you want to express your opt out.
And we've seen this over the last 18 to 24 months because the gold price in other currencies was actually at or near all-time high before the US dollar gold price just broke out over the last couple of months. I mean, wasn't the gold price in the euro, the Japanese yen, many other Asian currencies, it was already at or near an all-time high long before this rally in the US dollar gold price?
That's right. That's right. And I've had the question asked a number of times in the last few weeks. Gold's at all-time highs. Do you think it's too high in US dollar terms? And in my response each time is consider that it's just a measure of confidence in the currency itself. And you're really talking about a reflection of the currency's viability and policy strength, monetary policy strength. So it wasn't that many decades ago that the Japanese yen was a lot stronger than it is today. We're currently 34-year lows. But imagine back 50 years ago, and now you're talking about gold priced in yen, and it's only 5 digits. You're closer to 10,000 yen per ounce. And now we're almost at 400,000 yen per ounce. Is that a commentary on the gold price, or is that a commentary on kind of the ridiculous nature and the discrediting of BOJ policy, the Bank of Japan policy? And so when someone asks in US dollar terms if $2,300, $2,400 gold is too expensive to buy, it's really a question of how low can the dollar go, or how long does confidence remain in the US currency such that we're still thinking about gold in stable currency terms. If we're talking about a destabilized currency, there's no limit to the price.
Exactly. And also the gold price in US dollars, it's underperformed the consumer price index for years. I mean, if we're going to inflation adjust the gold price into the consumer price index to keep up, I mean, it has to go above 2,500 and stay there. It's probably closer to 3,000 with all the extra monetary inflation that's been created the last 3 or so years.
Yeah, I mean, the previous peak of 850, adjusted for inflation using the CPI, which is a modest measure of inflation, would put you somewhere between 36 and 3,800 an ounce before we were taking out the old all-time highs adjusted for inflation.
Yeah, I don't hear any of the experts on regular business television talk about that. That's very uncomfortable to bring up, how the gold price has not even kept pace with the consumer price index, because that's the argument right there, is we need to see higher gold prices because it's not keeping pace with the consumer price index.
I think one of the misconceptions about gold is that it's a very good inflation hedge. In real time, it's really not. But what it does do is eventually catch up. So in fits and spurts, that's what it ultimately does, is reflects the devaluation of a currency. If you're looking at it on a 1 month time frame, even a 1 or 2 year time frame, there's going to be periods of time where it's lagging or leading. And so it's currently lagging. I would argue that sets up for kind of a ratchet in price as it does ultimately catch up and just reflects reality.
Do you see strong demand continuing for gold and silver outside the United States? And what do you think would change the demand of Americans and Canadians? Because I'm seeing the articles now, and it looks like that a lot of Americans are starting to sell their gold jewelry and coins and bars. They're starting to sell it at pawn shops. And then a lot of these bullion dealers, David, I know you have the Vaulted app, which offers lower premiums for retail investors to buy physical gold and silver, take some delivery. But I've just read the complaints online about a lot of people with online bullion dealers. I won't name specific names, but there was people charging like insane premiums for American Silver Eagles. Do you think that that's going to have to be worked through with the bullion dealers? They're going to have to earn back their reputation for not gouging on premiums?
For sure. I mean, the premiums, look, there's been such a mass liquidation of product that there are virtually no premiums on any product today. If you're paying premiums, you're getting hosed. You're being taken advantage of, pure and simple. So, when I can buy maple leafs for the same price in the wholesale market as I can bars, that tells me something. I can get any product, any quantity of product without paying a premium today, because we have had Western investors dumping into this market, looking and saying, okay, all-time highs, I've been waiting for this for 10 years or 20 years, I'm out. And I think they're misreading the whole backdrop. And that's where, if the question is, do we continue to see demand increase? Do we continue to see the gold price improve? Who are the buyers? You have the non-price sensitive buyers, which is great. They're not buying for economic reasons necessarily. That would be your central banks. They're diversifying away from the dollar. It is a statement, as a protest vote against U.S. hegemony and against being subject to U.S. monetary policy. So there's an insulation factor that they would like from the status quo and from the system that's sort of run the show from 1944, the Bretton Woods Agreement forward. And so that protest vote, I think, continues at a strong pace. Then you've got, as we talked about offline, Japanese consumers stepping into the market with a new set of reasons. We are sitting at 34-year lows in Japanese yen, and we are days away from the Bank of Japan being forced to intervene to prop up the currency. If they don't, we already broke strong support at 152, and like a hot knife through butter, we went to 153, then 154, and it continues to remain under pressure. If you're a Japanese consumer, you look at that and certainly want to safeguard your resources. The demand dynamics there are good. And as you pointed out to me earlier, there's some tax incentives in Japan for investors to be considering it. And that's changed just since the first of the year. This year and last year, the Chinese consumer is faced with rotten prospects in the real estate market, the third year of declines in the Shanghai and Shenzhen stock markets, and a limitation in their ability to trade in cryptocurrencies. So when you want another option or when you want to preserve value, gold looks very attractive. And the Chinese market, rather, the Chinese currency market is also very weak. Doesn't appear to be as weak as the Japanese market because they've pegged to the US dollar. But that peg can break and is being sort of threatened within the market to break, trying to control the band as much as they can. They clearly have, well, we believe they have sufficient currency reserves to defend the currency. But again, if you're in China, you might look at this as a fairly fragile setup and think that gold represents a pretty reasonable opt-out. So you've got non-price sensitive buyers, you've got regional players in Asia who look at sort of destabilized currency regimes as a justification to have a little bit of insurance in the wings. And we have not even begun to attract the Western investor back into the gold market. The Western speculator, if you're looking at COT reports, certainly we've had an increase in open interest, and there is an initial foray into the gold market. And above that 2,100 mark on the US dollar gold price, things have gotten heavy and hot pretty quick. But again, we're talking about one slice. We're talking about one small piece of the overall Western gold buyer. Last year, what was it, $7-8 billion in liquidations from GLD and IAU. And this year, again, I think close to a 5% dumping of gold in your GLD and IAU, the ETF proxies. So 16% in liquidations of total assets last year, another 5% this year. We're running from the market when we should be running to the market. But I think our perspective is skewed by, chasing the latest and greatest. We are in love with AI. We are in love with NVIDIA. We're in love with the Mag 7. You just can't argue with what's working. So I think one of the things that will flip the switch for the Western investor is the same thing that's flipped the switch for the Chinese investor. If your other options all of a sudden aren't as attractive, then what do you do? And frankly, in a rising interest rate environment, do you want to opt out of stocks and go into bonds? I'm not sure that that's the greatest step to take.
Let me also add for China, there's rumors of a sizable yuan devaluation soon in under 12 months for a number of different reasons, whether that's bank bailouts. I mean, a lot of their banking system, the collateral is high real estate prices. So their banks are definitely hurting right now. And like you said, the Chinese retail investor, also institutional investor, I've been reading the interviews from the Financial Times, New York Times interviewing them. They've just lost faith in Chinese real estate and Chinese stocks. Well, with all the capital controls in China, David, they don't have a lot of investment options. And the main one right now is gold and silver.
Yeah, and in terms of the devaluation, if they can pull it off on a controlled basis, if they can manage a decline, makes all the sense in the world. And I could see that as being a priority from a policy perspective. They'll have to control it. They'll have to manage it. And that's the question, is if they start to devalue, can they actually control it? The reason they would want to is because they're having to shift away from economic growth tied to real estate development, which at one point was up to 40% of GDP, and they're having to shift focus back to, sort of their pre-real estate winner, which is just manufacture and distribute to the world. So the sort of the mercantilist model of growth, they're back at it and flooding the market with product X, Y, and Z, and they're not helped by being pegged to the US dollar. As long as the US dollar is strong, their currency is strong relative to other Asian currencies and other places that they would export to. And that puts them at a disadvantage with their only source of economic growth. So yes, absolutely, devaluation, controlled, managed, has to be in the cards. The question is if they can pull that off and maintain control of it.
Well, these emerging market currency devaluations, and I'm not saying China is a real emerging market. I mean, like they're a large economy now, although their consumer has a lot less purchasing power than the average American. And that's all adjusted with purchasing power parity. But you mentioned neo-mercantilism. I mean, neo-mercantilism, a lot of these economies that were doing that, these things blew up on currency wars, trade wars, protectionism. I mean, Trump is threatening, I don't know if he's going to win the election or not, or if he'll be allowed to run. We'll see what happens. Looks like it's a mess in the courts. But I mean, if he does win the election, he's promised that he's going to hike the tariffs on Chinese manufacturing, the goods, and even Chinese companies that set up in Mexico even further. And what I've heard from some Chinese manufacturing sources is that they're discussing devaluing the currency as kind of to try to offset those tariffs. So they're planning these things out ahead of time. But then we're back into what the policy mistakes of the 20s and 30s again with protectionism, currency wars, trade wars, tariffs, those types of things.
Yeah, I mean, the Biden administration is not that much different. Certainly, if Trump were to win, there would be all kinds of products that made a blacklist. But even this week, aluminum and steel are on the list for an increase in tariffs from the current 7.25% to over 22%. And that is being discussed as we speak. So Biden would do the same. Maybe he'd moderate that a little bit if he could keep 10%, 10% for the big guy. We could ease some of the pain for the Chinese, I suppose. But time will tell. You're right. This is a fraught situation. And if the way you're going to grow is by undermining the competition, this is not the globalization and the success that we saw tied to globalization, where everyone's economic slice is getting bigger as the whole pie grows. It's the opposite. And that's where trade wars come into place and protectionism comes into place. The economic pie shrinks, but you want to maintain the old size of your slice. And you're willing to do that at the expense of your trade partners, no longer partners, or your trade competitors. And that's an environment where trade wars can turn to hot wars.
It sounds like both political parties here in the US kind of are with polling or interested in doing that because they're kind of promising that, oh, if we put protectionism tariffs on Chinese goods, we can bring back more American jobs into factories here at higher wages, even though the cost of the goods and stuff like that for the consumer is going to go up.
And if you look at just the feverish growth in Mexico, you can already see that that's been in place for a couple of years now. Friendshoring, if it's not onshoring, at least it's friendshoring. And other than last week's kind of debacle with the Mexican peso, they've been doing very well, and their economic activity has been very impressive. And our trade with them has been record breaking. All time, in terms of the quantity of goods moving across the border, we're doing more business with them than we have ever. And so at a minimum, friendshoring, if not onshoring.
But you don't think that China will start buying more treasuries again, do you?
No need to. No desire to. That's no. I think that that ship has sailed.
Yeah, I mean, they're buying, I've just seen some of the charts. They're buying an insane amount of copper. They've been stockpiling it at way above the amounts that they normally buy in just the last 3 or 4 months. So people are wondering why they're doing that. Some of the macro experts on like financial Twitter. And I'm thinking like they're buying all this copper and other commodities, oil with strategic petroleum reserves. They're deciding to buy these commodities instead of treasuries.
Right. And maybe that's just buying ahead because, again, they want to manufacture more stuff. But, if you asked me, do I want to own treasury bills or gold? I'd say gold. Do I want to own treasury bills or have an exposure to oil? I'd say oil. There is a, but that's me thinking in economic terms. And I think we sometimes forget they don't have to make that decision. Some of the decisions that they make are non-economic and definitely political, definitely geopolitical. So that's one of the reasons why I think buying of treasuries, that era is over, and anything else makes sense, not as an expression of I'm buying hard assets for the potential of upside, which we might calculate, but instead just as anywhere but. We're not going to support our enemies.
They could also just build another new warehouse and just fill it to the brim with copper. And if the copper gets rusted, it can be recycled. If they misallocate and build bad buildings, they can scrap the copper. So the copper is not going to go to zero. But I mean, if the U.S. keeps running these budget deficits, devaluing the dollar, the real terms, the value of those treasury bills, I mean, nominally they could pay out a higher yield, but in real terms, it could be valued at lower and lower and lower, whereas the copper will still have value long term. It's not going to go to zero.
Well, and remember, they never bought the T-bills because they thought it was a good investment. They bought the T-bills because it employed more people. And the dollar recycling was important to them because it kept the game going. We continued to buy their goods. They bought our treasuries. It was kind of an I scratch your back, you scratch mine. But it wasn't because they had a love affair with, Janet Yellen or any of her predecessors, or think that our T-bills somehow are the greatest thing since sliced bread. It was pragmatic. It was political.
Well, also Gordon T. Long, he's talked about this for years. He described it as vendor financing. So that's where like the manufacturer gives the consumer or their counterparty some extra credit to go and buy their goods.
That's a great point. I like that.
So do you think then that we're going to see more of what Carmen Reinhart described globally, financial repression, yield curve control, stagflate, tax lie, or are they actually going to allow asset prices to go down? And deflation. Do you think that any of that will be allowed, or are we in an environment where they can't allow any of that?
Well, I don't know how they avoid asset deflation. I mean, at this point, if they allow asset deflation, they've got a whole another set of issues. I mean, this is where you find it's not just the Fed that's trapped; it's every central bank that is trapped. And as much as they can resort to yield curve control without triggering a major inflation. In the 1970s, it was debt monetization that added to sort of the inflationary fuel. Today, they'd say, "Oh no, we can sterilize those things and it's no big deal." I don't think I even know what that means. That's I had a conversation.
Wasn't that the claim? So you let me just ask you, since you've been covering this for 15 years, I mean, wasn't that the claims with the QE programs that it's just reserves for the banks, right? It's just reserves. All the QE programs, there were people saying it's not inflationary, that the stock market wasn't juice, home prices weren't juice. It's not really inflation. We just increased reserves for the banks. That was the argument for years, right?
Well, I think they were making the case that it's not going to be directly inflationary to the consumer, and they never really considered the impact of asset price inflation. The reality is, if you increase liquidity in the system anyway, anywhere, you're going to create an environment where asset price inflation is virtually guaranteed. And out of that asset price inflation comes a whole variety of unintended consequences. I mean, clearly you've got social and political discord and far more partisan politics. You have sort of the classic Marxist haves and have-nots. Those who have assets are quite happy with that because their net worth goes through the roof, and those who have not are set to suffer. Now the question is, do wages in any way keep people happy? Maybe. I mean, we're increasing wages a little bit. We've seen a decent step up in wages. Frankly, not enough to keep up with inflation. But I think the asset price inflation has already gotten to levels that are they're not justifiable. They're not sustainable. Housing affordability, worst ever in the U.S. There's a variety of factors that hit that. Or that impact that. The bond market, we got to zero, and in real terms, negative rates. We've played with negative nominal yields in other countries. What did it get us? Not a whole lot. I mean, so there's. I just don't know that they have. I don't know that they have a lot of latitude to goose the system from the standpoint of asset price inflation, with there being any real benefit to them. At this point, I think if they were to do that, you could stir a variety of revolutions around the world, and it would be very sort of labor based.
We've also had, really since the pandemic started, a lot of the monetary inflation and the budget deficits with the transfer payments, the stimmy checks, the supply chain disruptions. That monetary inflation's finally started to hit the consumer to where a lot of people are waking up and noticing, and it's affecting voters and polling now.
And that's probably the key difference between asset price inflation, where you've got money that kind of swirls around the financial markets and boosts asset values, encourages leverage speculators to just kind of go hog wild with any particular asset. It inspires a whole spate of creativity, whether it's NFTs or cryptos. I mean, anything is on the table. And when you've got really, really loose monetary conditions and tons of assets flown here and there in the financial markets.
And I remember
With the changes, with the changes post COVID, you've got money that's not floating in the financial markets, it's floating in the economy. So consumer price inflation takes off after major fiscal stimulus. And I think the danger is that Wall Street has lost its importance. And Washington, D.C. is very keen on getting control back from the moneyed elite. The powerful power brokers in D.C. recognize that Wall Street needs to die a little, and that what needs to be resurrected in its place is Beltway power. And so again, if you're gonna inflate, it's gonna be buying votes, it's gonna be new promises. And I don't know that they have connected the dots between fiscal stimulus and direct consumer price inflation. But that line is much clearer, and it impacts households immediately. And obviously, it impacts lower income households even more. So they could be just shooting themselves in the foot with that, but I'm not sure they understand the tight connection between fiscal stimulus and consumer price inflation.
Oh, I agree. There's still a lot of PhD economists here in the DC metro area that think that stagflation doesn't exist. I'm serious. Janet Yellen, even, she's a labor economist. She believes inherently, and she will deny reality, that stagflation exists, that there cannot be high inflation and low growth and high unemployment. She just does not believe it. I mean, but her comments though, and she's a DC policy wonk, and she just keeps getting promoted, more and more higher paying jobs and new pensions that when she goes to academia or goes and works at a hedge fund. I mean, her predictions, she said in 2015 or 2016, when she took over as Fed chairman, she said inflation was too low.
Yeah, I think I know what she was smoking in the 60s and 70s.
Well, she also said only a couple years later, 2018 or 2019, there wouldn't be another financial crisis in her lifetime.
Right. No, the econometric models don't factor in a lot of reality. And that's one of the things that is heartening, because I think on the other side of this, there's going to be a reappraisal of how we look at economics. And I think there's clearly room for improvement.
So on your money management business and your portfolio strategies, are they mostly towards inflation and commodities, dividend growth, or are you looking at deflation hedges too?
Yeah, so if we've finished a period of time where financial assets benefit from easy money policies and very low interest rates, so no inflation, low rates, I think the transition, as a part of our thesis, transition is to a totally different investment backdrop where inflation stays with us. Maybe it's 3%, maybe it's 4%, maybe it's not double digits. Now, again, it depends on how you count inflation. And obviously, there's ways, even Larry Summers is suggesting current inflation is closer to 8 or 9% than the current rate. But, whatever your number is, higher rates of inflation and higher interest rates going forward definitely take the wind out of the sails for financial assets. And I think they do put wind in the sails for your hard assets. So are we interested in infrastructure? Yes. Are we interested in global natural resources? Yes. Are we interested in precious metals mining companies? Yes. We have a category, a segment that is for specialty real estate, but for the last 2.5 to 3 years, we've had it below 2.5% of the total value of our accounts. real estate is, even though it's a hard asset, it's very leveraged and thus subject to the whims of finance costs. And so as goes the cost of capital, so goes a real estate portfolio. We'll be very interested in allocating to real estate at some point. That's kind of a one of our four segments, which is really skinny today. But, if you can stub your toe on it, we're interested in it. And so we manage portfolios of, 50 different equities and are looking for best management, best balance sheets, best geographies, and feel like we've got a great confirmation as we come into 2024 that it is a great place to be.
So for the precious metal side, you have brokers that help with like ratio trading, right? Gold to silver ratio or gold to platinum ratio, whichever metal you think is cheap, so you can earn more ounces long term. But you also have the lowest cost premiums, what with your Vaulted app too?
Yeah, just a little bit of history. We started 53 years ago, 1972, and had sort of a first mover advantage in the bullion market. Found a tax loophole that allowed us to be selling bullion when no one else could. And my dad helped with a couple of other gentlemen in the industry to get gold legalized January 1st, 1975. Fast forward to the 80s, we're the first company to put physical precious metals into IRAs. We've done that for thousands of people and continue to do that. About 5 years ago, we started the Vaulted program. Vaulted, either at the App Store or vaulted.com. It is our way of expressing our deepest desire for sound money. If you're looking for a savings alternative, you want a low-cost way to own large format gold and silver bars, 1,000-ounce silver bars with HSBC and kilo bars with the Royal Canadian Mint. You can do that, and it's allocated, it's deliverable, and we've compressed the costs. Going to the source, we've cut out the wholesale middleman, so fees are really compressed, and you've got kind of the best of all worlds. Serial numbered bars, that are deliverable, and with some great providers. So Vaulted is kind of our 21st century iteration. We've been kind of an industry leader from the industry's inception to the ways that we've thought that it needs to grow and change. We'd like to introduce by the end of the year a way for those savings to be deployable for anything, cup of coffee at Starbucks. And so the functionality, bringing gold and silver back in as essentially a means of exchange, can be done in the modern era, given technology and given the way that you can own bars in a stored location, either in London or in Canada.
Okay, so is that similar to what it's a digital gold or silver receipt? And then if you were going to go buy a coffee or a food at like a restaurant or Starbucks or something like that, it would sell a gram of gold or an ounce or two of silver or something like that, and would all be done digitally, and then the metal would just be subtracted, but then the receipts are digital with like your phone?
Well, I'm not sure I'm comfortable with the word receipt. You have actual physical metals. If you can swipe your debit card and spend your ounces, there's a translation that happens as you instantly convert from gold to dollars for the purpose of the transaction. And we have that functionality, that capability now. We've not rolled it out because we've got some other features within our Vaulted program which are even more compelling from a tech standpoint. So this will be the best program. I think it is the best program, but we continue to improve it as we go along, and are prioritizing a particular structure within the Vaulted program that gives it some advantages over any other bullion purchase possible on the market today.
That's very cool. I mean, the reason I brought up receipts is because the bimetallic or trimetallic, where you had gold, silver, copper, that those metal standards with certificates and or receipts, I mean, those worked very, very well until the government started cheating and debasing the currency, or the bank, the bullion dealer, started doing fractional reserve banking and cheating. But the systems were actually very convenient for the customer because you could go and exchange the metal, or you could use paper. So I mean, now with the digital and the technology, we could do it digitally.
Yeah, and the beauty of being able to save in any dollar amount, like our vault plan, somebody wants to save $100 from every paycheck, they can do that, and it automatically dollar cost averages into either a gold position or a silver position or a combination of the two, however you want to split it up. You can buy and sell in any dollar amount down to the penny, and it gives it that transactability. You know, in the olden days, you had a $1 gold coin, a 2.5, a 5, a 10, a $20 gold piece, and you know you could make change if you needed to in silver dollars. That is, I think we can do even better with this digital version. Again, it's a digital platform with actual physical allocated metals backing it.
Very cool. Well, I wish you the best of luck on that. I hope it works out. I've been advocating for years that we see some type of digital where someone makes this work with physical gold and silver backing it.
Well, we'll continue to try to serve the community as best we can. And I think this is a tremendous period of time to be allocating to physical metals. You know, silver is the standout value of the two at an 85-to-1 ratio today. It makes a tremendous amount of sense. Being able to bring it into the economy and engage in, you know, a currency system that is suffering from mismanagement, to be able to engage when you want to and on the terms that you choose, to me, that is what my dad set in motion 53 years ago. The value of individual autonomy and strengthening the reserves of an individual person and family to be able to navigate challenging waters and challenging times. You just got to have the right tools. Nothing is too hard to engage with and you know find success in if you've got sufficient reserves. We've got some challenges ahead, but I think with adequate reserves, we'll be in a decent place.
Now, I know you also look at the ratios too. You mentioned that silver is very weak against gold, the gold to silver ratio. I mean, I'm looking at platinum and palladium prices from a contrarian standpoint. I mean, the platinum price is way below the gold price now. Is that historically normal?
It's not normal. I think, you know, the concern in the marketplace is what happens to the internal combustion engine in the age of electric vehicles, and are we past the need for catalytic converters? That's roughly 50% of demand for platinum and palladium. And you know, so if we're moving into a new era of EVs, then the question of how relevant are those other white metals, it's a reasonable question. Now, I do think that the hype around EV and the transition towards electrification has been overdone. So if you paint with a broad brushstroke, you could say, for sure, Jason, 10 years from now, I don't know that you want to own platinum or palladium. In the next 10 years, you're going to have, I think, you know, revenge of the markets as people realize, you know, number one, we don't have all the access that we need to infinite amounts of copper, lithium, cobalt, anything else that you would need for moving towards electrification. And, you know, the constraints there on the supply side don't match the political will. So what does that mean? It means probably that platinum and palladium are too cheap. And you've probably got within that 10-year window a couple of trades that are going to be very profitable. They've been discounted to sort of that category of irrelevant, and I think it doesn't match a market delivery time frame for the electric vehicle and the electrification, the green agenda, if you will.
I'm reading research reports the last 6 months from investment banks that there's going to be platinum and palladium shortages in the next couple of years. A lot of it's supply side based. So even if the demand is lower than expected, I mean, there's supply side problems. The majority of the world's supply is from Russia and Zimbabwe. And I think the London Metals Exchange just said they're not going to buy any Russian metals. So I think that includes the platinum group metals. So I don't know where the supply is going to come from if they're not going to buy Russian platinum and palladium.
It's fascinating to me. You kind of know how thin a market is based on its bid-ask spread. And if you wanted to step into the market today and buy $1 million worth of palladium, your bid-ask spread is between 5 and 10%. I mean, it is so thin. There is so little product available. I could make, I would probably have to go to the London market to get a sizable amount of palladium today, and platinum's not that much different. There's just not a lot of it out there. And it's one of the reasons why the big three auto, when they buy, when their purchasing managers buy, they buy years worth of supply before they need it. So I think that's one of the things as you see sort of, these indications of stress and strain, whether it's Rivian trading at 90% off of its IPO pricing, or a number of the EV companies which have already gone bankrupt. Tesla, we'll see how they come out this week. There's reason to believe that they can't make this transition as fast as they can, as fast as they were anticipating. When the big three auto are shutting down plants, that are making the Ford truck, the electric Ford truck. I guess what I'm getting at is they're going to have to reconsider themselves in terms of their own business plan. A lot of them in the boardroom bought the hype. They bought the hype of this green revolution, and the consumer's not interested. Not today, which means they're going to have to go back to the drawing boards in terms of their production of ICE, internal combustion engines. And they are probably going to be big purchasers of one or the other of those metals, or both, because they've let their supplies dwindle, and the price is reflective of that.
Or they just do what Toyota did. Toyota held pretty much steadfast, and they didn't overinvest into electric vehicles. They stuck with hybrids, and hybrids still need catalytic converters still.
I think it's brilliant. I think they were very realistic, and I hope they are rewarded for it with market share.
I think they will be. I think they will be. They're pretty efficient at a lot of stuff here, and they didn't cave to all the pressure like Ford and General Motors. The electric vehicle companies, a lot of them could potentially be bankrupt in the next 6 to 12 months without bailouts.
There's no doubt. You look at their balance sheets and their current cash burn ratios, and they've got a date with destiny.
Well, I know the DC metro area doesn't like this because I get all these emails and nasty comments from think tank people and PhD economists that are on that gravy train. But I call ESGs solar, wind, electric vehicles, biofuels, these things. It's the energy spending grift. And it doesn't help consumers or businesses. Mostly it causes higher electricity costs and shortages. The infrastructure for a lot of this stuff's bad. And yet DC metro area and politicians, bureaucrats, a lot of these corrupt large corporations, they want to keep pushing it.
It's just, I applaud them for wanting to make the world a better place. If that's in fact what they're after, then their aspirations are noble. I think what they forgot is, the timelines and the logistics of making such significant changes to infrastructure, and the stresses and strains that we would have to put on infrastructure to match ideals with reality. And so, that's what we're coming up against. It was a JP Morgan who was quoted in the Financial Times just this week saying we're going to have to shift our expectations a bit. Fossil fuels not going away. And this is not just a multi-year process. We're not going to hit our targets, our aspirational targets in the 2030s. In fact, this may be several generations away, not even decades, but generations away. And that I think is realistic. I don't think you need to let go of ideals, but it's very important to have a serious time frame for when that can be done. And you can't just say we'll tax people more and speed up the time frame. There are limits. I mean, you look at South America as an example, Chile. I'm thinking of your state-run companies down there cannot increase production of copper sufficient to meet global demand. And we're talking about a major ratchet in terms of demand for copper to move towards the kind of electrification ideals that the globe has, even that North America has. And that's an issue. If you don't have the supply, how do you get it done? It's a very practical consideration. And that's the reality is some of your largest mines, and there's no will in the US to change. I mean, you've got Rio with Resolution Copper, that project, which has been on ice for a long time. Well, we could be producing a massive amount of copper from Resolution in the US, and we're not. Why? Because our ideals don't match the realities to meet them. And so you're going to have a compromise from the EPA. You're going to have a compromise from the folks in the Beltway who hold up their ideals but aren't willing to look at what it takes to do that. The same thing with lithium. You've got the Jadar mine over in Eastern Europe, and we're all for digging and mining and getting the resources that we need to make our world prettier and decarbonized. But you go to that community, and you know what their response is? Not in my backyard. And in fact, that is my backyard. That's where my kids play. And you're talking about turning it into a monster mine. No, we're not interested. We don't care about the billions of dollars flowing. We care about the quality of life, and we care about where we live. So you save the world at someone else's aesthetic expense and health expense, right? So again, you're just dealing with ideals and the reality of what it takes to get there. And it's like the right hand was not talking to the left hand when everything was mapped out for the Paris Accord and things like that.
Well, it's also the same thing with nuclear energy, nuclear power, because you have people that complain and bitch or shut down their businesses or threaten to move factories out of the country if electricity costs go up enormously. I mean, some small businesses in Europe, their electricity bill went up $1,000 a month. I mean, the average small business, that's a huge hit to the bottom line right there. But then they say they don't want nuclear power anywhere near them, which is like the most efficient, cheapest form of electricity. So they don't want coal, they don't want liquefied natural gas, and they don't want nuclear power, but then they also don't want their electricity bill to go up $1,000 a month. So, I mean, you can't have both.
That is where the compromise will be made, though, on nuclear. Whether it's thorium or U3O8, that's where the green energy trend has to go if they want to survive, if they want to maintain credibility.
And I don't think the global economy can run without cheap electricity. So we have to have cheap, especially for all these technology stuff that's planned. I mean, we need cheap electricity. We need the copper. But like you said, all the copper supply, whether it's Chile, Mexico, Peru, Panama, all those countries are becoming either anti-mining or their copper and silver supply is in a permanent downtrend the last 5 to 7 years.
Right. And just when we have sort of this deglobalization trend, people focusing on maintaining their slice of the pie. You've got politicians who, in various geographies, are moving towards nationalization of natural resources. So you're dealing with even greater supply constraints going forward. Panama is a classic example. Cobre Panama, responsible for 3.25% of the world's copper supply, no longer available. No longer available. Why? Because the Panamanian government suspended the license and it's done. Maybe it comes back online. Maybe something gets negotiated. Maybe a major mining company comes in and shifts the balance of benefit in the direction of the Panamanian government. But you're talking about something that represents 5% of GDP, and they're willing to shut it down. I don't know that trend is going to end, which, when we manage our hard asset portfolios, this is really critical to us. The geographies, tier one geographies, if you're not focused on that, it's a fool's errand, because you may have high production mines today that you have no right to tomorrow. So, it is quality managers. Hard rock mining is a hard job. You have to have quality experience. You have to have great balance sheets. You've got to be in the right geographies. That takes a lot of work to figure out and manage. And I mean, we love doing it. We've got a phenomenal team doing it. But it's something you have to pay more and more attention to as governments around the world say, gosh, you're making a lot of money. I bet I could make all of that money if I were doing it myself. Little do they know how complicated it is to actually get that done. You can have a PhD in geology and still not be a good mine operator. I mean, and it's just hard work.
And most government people in the mining finance area, they do in the mine department there, they do not have PhDs in geology. A lot of them were nepotism. They got a cushy government job there and got assigned that.
That's right.
Well, I think if the governments, I mean, I've heard this before that the governments are going to start nationalizing. Gold price hits 3,000, 4,000, 5,000. The governments are going to nationalize the mine. I mean, I think the governments, they are paying attention to the metals price, especially if it's in what an emerging market and a lot of their economy is based around mining and oil and natural gas. I mean, they will want to renegotiate the royalty taxes. I think they're looking that if they nationalize or confiscate the mine, the cash flows are going to go to zero. So I think they will want to just renegotiate a higher royalty tax. That seems to be what they want to do first.
Yep, I agree.
Yeah, so that's like it's kind of, I mean, the mining company's not going to make as much money, but then they're not going to have the assets nationalized. So, I mean, if the government start trying to run these things, I mean, the cash flows, the business will collapse.
Right. No, that's true. I think the margin story is largely missed within the precious metals mining complex. And you can see quality companies selling at a discount to their net asset value, even while their margins are between 50 and 60%. Average all-in sustaining costs at 1450. You've got companies that are making 850 bucks per ounce produced. And that's assuming that gold prices stay where they're at. They're making really good money, and the market is not recognizing it. So,
Oh, yeah, I agree.
silver
100%.
gold silver ratio, I think that closes the gap in terms of performance, and I think you see the mining space a little bit more pep in the step as we close out the year.
Well, also we haven't seen the free cash flow numbers that you just said. We're not going to see those to the Q2 earnings. So the market's going to want to see that it's going to be show me in June or July. So we're not going to start to see those numbers, the free cash flow, the earnings till the second quarter earnings are announced and the conference call. So that's when we're going to start to see that these businesses, the gold miners, the oil companies are minting free cash flow.
You should be positioning before that's announced because it's such a small space. You'd be surprised how fast they move with just a little capital sprinkled in.
Oh, I agree. I think Stanley Druckenmiller was way ahead. I mean, when he started selling Nvidia and the artificial intelligence stocks, the large cap tech stocks, started buying what commodities companies, gold miners about 6 weeks ago, people are like, what is he doing?
He's a talented trader. He's good at what he's done he's been that way for a long time.
Well, I think he's the top performing hedge fund manager over the last 30 or 40 years.
Don't take losses, and occasionally you get really big gains and your returns look spectacular. There's a lot of years where he doesn't have to make any money. He just has to avoid losing it. And then you get a couple of big wins and your average rates of return are spectacular. I mean, he's if you looked at his performance, you could describe it as lumpy. But that's all right. It's not lumpy because he was losing gobs of money. Dalio's getting better at that, and better as time goes on, really refining his skills as a money loser. Risk Parity's a dinosaur at this point. But somebody like Druckenmiller, who's not committed to one particular theme or style, his talents, I think, will continue to benefit he and his family office.
And he looks for central bank liquidity flows. He's willing to rotate out of other asset classes. If I remember correctly, he was in Nvidia and artificial intelligence stocks 18, 24 months ago. So he was ahead of others. And now that he's made large profits on those, he's cashing out and looking for cheap and hated, undervalued companies that can grow profits.
Yeah, Barrick's not my favorite. You've got geography problems. I'd say the majority of their mines are in tier 3 and 4. Not great geographies, but at a 38% discount to net asset value, and a company that is expected, you would expect, given its market cap, to attract institutional capital. I think he could have done better in terms of the quality of company, but I think he's also positioning for capital flow. Like, a surfer gets in front of a wave, you anticipate where the wave is going to be, and then you ride it. He is no fool. I just would have chosen probably a different set of companies. You can still maintain your liquidity and not suffer from rough geographies.
Well, he's a large capital manager, even though he's a family office. I don't think he's a hedge fund manager anymore. But when you're a really big money manager like a Warren Buffett or a Druckenmiller, you can't go buy some of these junior producers. I mean, I guess maybe you could buy some mid-tier gold miners, but you can't go and buy a lot of these small cap companies. I mean, Buffett has said that in the past he can't go buy a lot of these small caps anymore and get 30 or 40% compound annual returns anymore.
Now, he did have other options. I think what he chose was, for liquidity purposes primarily. That's, knowing that he can move in and move out. That was a top priority. But again, I think he would have done well to refine the search a little bit for tier one and tier two in terms of the geographies.
Well, I've kept you for over an hour today, David. I want to thank you so much for your time. Please tell my listeners more about the McAlvany Weekly Commentary and the McAlvany Financial Group.
Well, a family-owned business for 50 plus years. We love hard assets. Think of ourselves as the one-stop shop for hard assets, and that covers kind of the king and queen of hard assets: physical gold and silver. Vaulted is sort of our modern expression, but we've been doing the IRAs, as I mentioned, since '86, and bullion since '72. What we do with the commentary is unique. Been doing it for almost 17 years now, every week, and there's a lot of helpful conversations just trying to figure out what's going on in the world. So it is kind of an expression of my curiosity and problems that we're trying to solve, things that we want to understand more deeply. And if it goes beyond resources that we have immediate access to, we're happy to talk to, Anat Marising, European Central Bank, or folks at the Bank of England, or you mentioned Carmen Reinhart back in 2015. She went on to be chief economist at the IMF and World Bank. We're interested in figuring out the world we live in, get as much background on context so that we can make wise decisions in the allocation process. And more than ever, having an appropriately broad context for making your decisions is super important. Geopolitics, clearly, one of the most underestimated important areas of study. International relations as a part of that. That usually is not looked at by a Wall Street firm. Not really interested. They're doing good work, but it's just too narrow, frankly. So I think broadening perspective is what we've tried to do with the commentary. You can go to McAlvany.com and go just about anywhere from there, looking at our hard asset strategies in the financial markets, or our gold and silver offerings, and certainly a whole list of resources. Let me mention two more that I think are vital. I do the weekly commentary. That's a podcast every Friday, Saturday, actually. We put out something called Hard Asset Insights, 5 to 7 pages of really top-notch writing on the hard asset space. And then Doug Noland, who's been with us since 2017, is not only manager of a short fund that we run, but he also has the Credit Bubble Bulletin, which he publishes every Saturday. Absolutely invaluable. If you're interested in markets and want a depth of understanding, Hard Asset Insights, the McAlvany Weekly Commentary, the Credit Bubble Bulletin, all these things are free resources at McAlvany.com. Please take advantage of them.
And Credit Bubble Bulletin is one of the longest financial blogs. I think it started in 2000.
Right. He originally was writing with and for Kurt Rishabasher, and sort of had his early training in the credit markets with that famed economist, and then has run a variety of hedge funds and mutual funds through the years. And we're honored to have him on the team. He plays the role of not only sort of chief risk officer for our hard asset strategies, but he also is the portfolio manager for our tactical short, which is an amazing way to hedge against market downside. And really talented guy, super thoughtful, hardest working man I think I've ever met.